afternoon, happy Friday, happy St. Patrick's Day. Mark Milam here, your mortgage professional with Highland Mortgage. Let's get right to it. What happened this past week? Well, a really volatile week, and not for the reasons that we thought, maybe going back early into the beginning of March. So the beginning of March, we had eyes on this week because we knew the Consumer Price Index, the most broadly recognized measure of inflation, was coming out on Tuesday. All eyes on that, so the Fed would know whether it was going to raise the Fed funds rate by 0.5 point or 1/4 point come next Wednesday, March the 22nd. And so we've been anticipating this week for a long time, but as it turns out, there's a much different player in effect that's moving interest rates, and that's what's happening in the global banking system. But particularly here in the United States, we've seen 3 banks fail, now one of which was a crypto bank. That was the Silvergate Bank collapse. Now the other 2 have much more profound impact on our market. That is the SVB out Silicon Valley Bank out in California, and then we know about Signature Bank as well. These banks very negatively impacted by the recent run-up in interest rates. There's liquidity issues and a run on the banks. Next thing you know, the banks are going under, and the government has to step in with an emergency rescue plan to kind of prop banks up. We've seen this contagion is not limited to the United States. Credit Suisse running into problems requiring the backing. That's the second largest bank in Switzerland, so they're requiring some financial support. And then also we've got now First Republic Bank. We're hearing reports today that First Republic Bank back here in the United States, I believe that's the 14th largest bank by asset here in the United States, looks like it's requiring some injection of liquidity to remain solvent. All of this jittery nerves pushes money into bonds. That helps mortgage rates improve. So we were the beneficiary of that, and largely we're finishing out the week roughly 1/4 point better than how we started the week. Let me flip the screen around here and give you a picture that's worth 1,000 words. So this is what's been happening over the past 5 business days right here. You can see a lot of green on the board. That's very welcome. We haven't had a lot of that over the past year. So we can see some of this volatility though. If you can see this really thin line here, this tells you the entire day's trading range, and you can see there's been a lot of ups and downs with mortgage-backed securities this week, trying to assess the severity of what's happening in the global banking system. If we just look at the economic data, hasn't been too terrible. It's actually been pretty decent. Let me shift here to a different slide, and we can check out the consumer sentiment, down 63.4 against a consensus estimates of 67, showing that consumers are a little more pessimistic. That's actually what we need to help rein in inflation. This is a move in the right direction for us. If we go back, we can see the European Central Bank raised rates by 50 basis points back on March the 16th. And then we had a slew of economic data to start the week. Weekly jobless claims. Really, this report, I'm coming to realize, just full of holes, full of misinformation. So the market largely discounting that, but the Philadelphia Fed manufacturing number coming in very, very low. This is sort of a harbinger of things to come. Perhaps that we're going to see inflation come in under control now that manufacturing has really fallen off a cliff here. Housing starts coming in a little bit hotter, and building permits coming in a little bit hotter than anticipated. But if we take you all the way back here to the CPI figure, that report that we thought would be so important really came in largely at expectations. CPI up 0.4 month over month, roughly 6% year over year. And we can see the producer price index, a measure of what it's costing to make all these goods, coming in a little bit under expectations. All of this relatively good news for mortgage interest rates, but the thing that is pushing interest rates lower is really what's happening with the global banking. And Goldman Sachs going so far as to say that they see no Fed rate hike now in March, that come March 22nd, a lot of people thinking we're going to go 1/4 point, we're going to go 0.5 point. Well, now Goldman Sachs thinking the Fed is just going to hold steady. It remains to be seen exactly what the Fed will do. And then you can see the news on First Republic, the Dow Jones sliding 400 points as concerns start to rise about First Republic. That would be the 4th U.S. bank now that comes under concern. First Republic securing roughly $30 billion in rescue packages from large banks to remain solvent. So it's a situation that merits watching as we move through the second half of March, but in the short run, those out there looking for a home, seeking to purchase their new first-time home buyer, or maybe it's a move-up home, are the beneficiaries of lower rates this week, thanks to what's happening with the global banking crisis. If I can be of any service to you over the weekend, don't hesitate to reach out. Mark.Milam at HighlandMTG.com. Have a good weekend.